President Trump and Putin agreed to talks to end the war in Ukraine. The U.S. Defense Secretary insists the discussions are not a betrayal of Kyiv. European stocks and the euro rise as U.S.-Russia talks spark optimism. The pound strengthens as the U.K. also escapes the threat of recession. Plus, Barclays falls as its results underwhelm, despite traders turning in their best fourth-quarter performance in at least a decade. Well, let's take a look at the European markets map. Again, we're seeing a little bit of green. There's quite a lot of earnings that we have to get through. The UK actually down some 0.8%, but you're seeing elsewhere the DAX and the CAC 40 0.7%. The FTSE MIB over in Italy 0.2% higher. We're looking at inflation that we had yesterday in the US. A couple of the big banks actually changed their calls for the Fed decision. But again, talks between the US and Russia seem to have spurred a little bit of optimism out there about a possible end to the Ukraine war. This is a picture overall for Treasuries, but we're also looking at gilts and what we're seeing in gold. Now, gold is very clearly a risk haven. If you look at Brent crude 74.79, euro dollar 104.14, and then a U.S. 10-year yield at 4.5974. A couple of other things we need to watch out for. Look, the IEA has cut its estimate for 2025 oil surplus, citing sanctions and demand. And on the back of that, I don't know if Brent is pretty much range-bound, but we'll see exactly what the discussions also with Russia happen over the weekend in Munich. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a dramatic reversal of U.S. foreign policy on Russia's invasion of Ukraine and a plan that could potentially cost Europe's major powers an additional $3.1 trillion over the next 10 years. Now, the U.S. Defense Secretary is in Brussels for a NATO summit after President Trump agreed in a phone call with his Russian counterpart to start negotiating an end to the war. Well, Hegseth denied the move was a breach of trust.
It's certainly not a betrayal. As I said to our allies yesterday, we recognize the incredible commitment that has been made over many years. And no country, as the President Trump has pointed out, has made a larger commitment.
Now, for more on all of this, let's bring in Bloomberg's Oliver Crook and our EMEA News Director, Roz Matheson. So, Ollie, you're in Munich. Of course, the Munich Security Conference starts a little bit later on. The Defense Secretary there just walked in. Who from the Trump team is at the Munich Security Conference, and what can we actually expect to hear from them?
Yeah, listen, Francine, I think this is a really consequential meeting because this is really basically the first high-level meeting between the new Trump administration and leaders of the European capitals and various other ministers that are going to be here in Munich for over the next couple of days. So we have Marco Rubio, the Secretary of State, will be here. We will have J.D. Vance, the Vice President of the United States. We'll also have Keith Kellogg, who is the sort of envoy for Ukraine and Russia and really sort of negotiating some of these sort of peace plan. And again, what the Europeans would like to see is what is included in this peace plan that Donald Trump has in his mind. Again, we're starting to get some of the contours of that from the Defense Secretary of the United States, Pete Hegseth, speaking in Brussels yesterday. I'll give you some of the headlines, basically ruling out the idea that Ukraine could even in the long term be joining NATO, saying that that's off the menu, saying that basically land concessions to Russia will be sort of a necessity, saying that basically the Europeans need to get that defense NATO spending up. That 5% figure is not going anywhere. But all of these things, many of them, and some of the people who have a more practical view of how to end the war in Ukraine will say that it's sort of obvious that basically Ukraine will have to give up some territory. The real concern is that basically making those concessions unilaterally, saying these things with Putin and Trump just on the phone call is something that is going to create a great deal of concern, obviously, in Ukraine, but obviously for the Europeans who don't appear to even have a seat at the table. So this is really their first opportunity to get some insight on their thinking. It's not even clear if they're going to get some input, really, or how much input in the plans that the Trump administration is putting forward for Ukraine.
Yeah, and Ross, this is really crucial because the situation seems pretty fluid. There's no real peace plan. We're not 100% sure what's actually being negotiated.
Well, that's right. And despite these meetings that are happening today with the Defense Secretary, really all of this has been driven by one person in the US, and that's Donald Trump. It's really his plan, his direct contact with the Russian president, what he really wants to happen from this. And it's very clear that, Donald Trump wants this war to come to an end quickly. He's got a vested interest for the US, particularly in what the US he sees gets back out of it in terms of it's put a massive amount of financial and military support into Ukraine. What does he get in return? And so Europe obviously anxious, as we were just hearing, about their seat at the table. But we're having a lot of direct conversations now between the US and Russia, a possible meeting in Saudi Arabia, in-person meeting between Putin and Trump. Trump indicated that's on the cards. When exactly, we don't know. But it's really, at this point, accelerating, it sounds, and being driven very much by that. And again, where does that leave Ukraine in the conversation? Where does that leave Europe in the conversation? And does Trump just want this wrapped up?
And Roz, we don't really know actually what was said, right, in that conversation between Trump and Putin.
Well, that's right. We know it went for about an hour, so it was obviously a long conversation. They say they talked about a variety of things, including obviously the conflict in Ukraine, but also energy, because we know that this conflict has upended, global supply and prices, be it around gas or oil or whatnot. And so a lot of conversation around that. But again, this seems to be, above all, a move to reset the relationship and move Vladimir Putin away from years of being described by the US as a pariah.
And Ali, what's been the reaction so far from Ukraine and President Zelensky?
Listen, I think that there's a real consciousness from President Zelensky that basically none of this can happen without the United States administration. He said it many, many times in the past, even talking about security guarantees after a ceasefire as recently as this week, saying that basically any security guarantees that don't involve the U.S. are not real security guarantees. So this is going to be fundamental. They're going to a certain degree, have to take what the United States has to offer. And what potentially Ukraine has to offer the United States is something that is currently, or was just currently being explored by the U.S. Treasury Secretary Scott Bessent, who has been in Kyiv to discuss some economic access from the United States into Ukraine, because the Americans still want to leave the door open to be able to support Ukraine. The thing is, they are not going to do it for free. So they're trying to find ways that maybe they can get paid back in a certain sense. Could that be access to minerals within Ukraine? That is one of the things that is being discussed, more economic access sort of going forward. But again, I think also the other key point is going forward, what will the sort of peacekeeping situation look like in Ukraine if there is a ceasefire? The United States has said they want no part in it. Basically, they're trying to get the Europeans to put soldiers there. I have spoken to senior lawmakers in the Defense Committee in Germany, very hawkish people who have really been in support of Ukraine, and even they say that that is maybe a shade too far. So all of these things are going to be discussed here at the Munich Security Conference, basically being foisted onto the Europeans, who really feel like they're in reaction mode, have not woken up to the new reality of American foreign policy, which is not multilateralism, it is unilateralism.
Ollie, thanks so much. Oliver Crook there in Munich. We'll also, of course, be live from the Munich Security Conference all day tomorrow with interviews, including the German Armed Defense Forces Chief, the Saab Chief Executive, Kongsberg Defense and Aerospace President, and the German Foreign Minister. We may also have a panel or two. Now, Roz stays with us, and then we'll talk about markets. But, Roz, let's turn to President Trump and Elon Musk's efforts to cut federal jobs. So around 75,000 employees have signed up for voluntary resignation. I mean, what more do we know?
Well, in fact, that falls short of what we thought was going to be the goal of this exercise. It's around 3% of federal civilian employees. They were talking about 5 to 10%. So that opens the door to potential mass layoffs that may now be announced by this administration. There's also the question of, again, just how deep and far is this DOGE effort going? We saw Elon Musk this morning saying that he wants whole agencies shut down. Again, what agencies are we talking about? And in this broad announcements of kind of, we're going to do funding freezes, we're going to go through all these agencies. What are the ramifications of that and the knock-on effects? Do we see widespread layoffs? Do we see funding cuts? Is this money being saved? Where is it being saved? Where is it going? How does that collide with Congress in terms of fiscal oversight? So again, a lot of broad comments about intent, a lot we don't know about reality.
Yeah, and actually this is what Elon Musk had to say in the press conference.
We have to really delete entire agencies, many of them. That's not to say there won't be an increase over time of bureaucracy in some new administration, but it'll be from a much lower baseline. So it's a step in the right direction. I think the overarching goal here is to lay the foundation for prosperity that will last many decades, maybe centuries.
Roz, I mean, he's really left, right and center. This is a day after we also saw him in the Oval Office with the president.
Well, that's right. And those images were very stark in the Oval Office with his son also. But, talking with Donald Trump, getting again that stamp of approval. But as you say, we don't know a lot about Doge. We don't even know who's working for Doge, and we don't know what their access is going to be. And we're talking about whole departments. That just causes quite a lot of unease. Donald Trump yesterday talking about shutting down the education department, for example. So again, a lot we don't know about this program and whether it's going to reach fully into the payment structure or not.
Roz, thank you so much. Our Bloomberg EMEA News Director, Roz Matheson. Now, joining us now is Grace Peters, Global Head of Investment Strategy at JPMorgan. Grace, I mean, I guess the concern is that do you still just, look at markets inflation, or do you suddenly have to be a geopolitical expert?
No, I think we want to stick to the fundamentals and to what we know.
So tariffs, trade wars, and kind of that policy.
Doesn't sound happy, does it? I would also add to that earnings, fourth quarter earnings season looking pretty strong. And so, how are we digesting all of that? I think, as I say, sticking with the fundamentals, first and foremost, the data today is broadly still good. Yes, we do have hotter inflation, which maybe we should come on and talk about. But I think overall, the data of what the companies are saying, the outlook statements, as well as that backward-looking data remain solid, which we think there's more upside to risk assets. But the tail risks are most definitely there. All these questions manifest ultimately in, I think, two key tail risks. Is inflation actually meaningfully pushing higher to an extent that would be disruptive, given reasonably full valuations and small risk premia? Or indeed, could things like tariffs actually bring down growth forecasts, and are recession risks perhaps actually higher than the market's pricing? So portfolio resilience to us is the big theme of 2025, which is intended to stay. We think this is still a time to be invested, to be pro-risk, pro-cyclical, but you need specific assets in there to safeguard against these other tail risks, which are equally real.
So, Grace, first of all, what does the Fed, can the Fed cut rates this year?
I don't think there's any need for the Fed to cut soon, sort of say between now and June. The inflation data that we had yesterday, I'd say, we should definitely take note of. I don't think we need to panic yet, but we are seeing firmness across the board in the core metrics. And it's not the only data point. When we think about the University of Michigan medium-term inflation expectations we had a couple of weeks ago, that also pointed to this firming after a flatlining of inflation last year, perhaps affirming this year. But other measures, particularly when we think about wages, that's telling us still that the labour market is cooling and we don't need to, hit panic. So I don't think the Fed is in any rush to cut. They're going to remain data dependent. Let's see what the data looks like in the second half of the year. But I don't think there's any urgency at the moment.
So how do you build that resilient portfolio? What are you looking at the moment?
Yes, absolutely. So global equities for one. It's obvious to be overweight US equities. US exceptionalism, I think, is very real when it comes to productivity growth. But in the markets, we have to then say, well, a lot of that is already in the price, with the US at 23 times forward earnings versus Europe at 13.5. So invest globally. And then I think you can capture some of the upside to positive surprises, like perhaps the notion that we could see, sort of more peace going forwards when it comes to some of these geopolitical issues. So I think stay invested in equities. For the upside inflation risks and geopolitical issues, gold to us is still absolutely a standout asset, and core infrastructure, because that gives you yield, but it also gives you a degree of inflation protection and also uncorrelated returns, because I think part of this is also thinking about if there's an equity drawdown, where are we going to get the protection in the portfolio? So core infrastructure offers that, and hedge funds would be the other piece that I would mention, particularly macro and relative value. And then for those downside growth risks, duration still is the best asset. So it's about how you blend it all together, but with the curve pricing one cut only for the rest of this cycle, then I think, sort of thinking about adding a little bit of duration to protect for those downside growth risks in that broader portfolio context.
Great. Specifically in Europe, do you buy anything right now, or do you wait and see what the situation is also like between Ukraine and Russia?
Yes, I mean, the market price is on incremental news, and the incremental news feels to be slightly more optimistic. So, as I say, we like Europe as part of a global portfolio, and we do think that there are some areas where Europe will lead in sectors that are really interesting. Industrials would be part of that. The luxury goods sector for us is always a mainstay in Europe. And I think even some of the financials, may see an improvement in their backdrop in Europe if you start to see broader investment picking up and sentiment improving. Financials, we think, actually globally is a really interesting sector where, sort of the current backdrop and the broadening we're seeing in markets we think is really interesting.
Grace, thanks so much. Grace Peters, Global Head of Investment Strategy at JPMorgan, stays with us. We'll have plenty more, of course, on Europe, but also Asia. This is Bloomberg. Welcome back, everyone. U.S. inflation picked up broadly last month, further undercutting chances of multiple Fed cuts this year. Now, the Fed Chair, Jay Powell, also says the central bank has made substantial progress towards taming inflation, but there is still more work to do. Let's get back to Grace Peters, Global Head of Investment Strategy at JPMorgan Private Bank. Grace, thank you so much for sticking around. We were talking a little bit before about the Fed, and you say, look, you don't think the Fed should be in any hurry to cut rates. What does this policy change or, adaptation mean for the rest of the world and other central banks?
Yes, well, I mean, all central banks, I think, are in data-dependent mode ultimately. But when we're looking at the US data and this, sort of the path of inflation with the question marks around that now, that is quite different from other parts of the world, particularly Europe, where we do think that, not only have you got quite lackluster growth, but actually the forward-looking indicators also imply that the labour market could be at the point where it starts to weaken. And that would imply that the ECB should just continue. I mean, they've spoken, sort of quite vocally recently about where they think the neutral rate is, 175 to 225. And we're still some way above that. So I think the path of the ECB, i.e. that divergence, is likely to continue over the next 12 months, because that is what the data is saying that they should do.
And what's your take on China and how much, I guess, that China still has concerns on real estate? Alibaba is actually on a tear at the moment because of AI-related things. But are we importing deflation from China, or that's still unclear?
I think it's still unclear to some extent, but I mean the backdrop in China to us is still really that, yes, we've had some stimulus measures that are helpful, that's helpful to sentiment, but the underlying issue really does stay with the property sector, with the underlying fact that most Chinese households have got about 60% of their wealth tied into the property sector, and therefore until we really start to see a turn in property prices and sentiment towards that sector, the consumer is always still going to have that cautious tone to them. And so China for us, obviously there are stocks that are doing well and there are themes within that are very pertinent to invest in. But just from a top-down perspective, we think growth is still slowing over the next few years in that region.
And that, of course, is impacting earnings.
It does impact earnings. I mean, one of the ways that I like to invest in the China growth story would actually be back through Europe. And there are different ways you can do that, whether it's on the consumer side or more on the industrial side. But I think that is a very legitimate strategy to get exposure to these global trends, but through a market where the risk premium is low and, things could go right. So, I think the US is still the obvious play. We are overweight the US, but that's why I think investing globally is still better investment advice than just investing in the US.
When you look at earnings, is AI or tech stocks, are they still priced to perfection? It feels like a lot of the good news has already been priced in.
Yes, I would say, if we look to the US in particular, where we're about 70% of the way through this quarter's earnings, the bit that has been pretty lackluster is the tech sector. And that's relative to expectations, which, as you say, Francine, are pretty sky high. So over the last 2 years, we've seen consistent top-line beats from US large cap tech, and this time they're in line. But, in line's not quite good enough. And we've got other sectors where you're actually seeing strong beats come through. And I'd pull out financials, US financials, as part of that, where, yes, the stocks have done well year to date, but the earnings news that we've had has only cemented that there are good underlying drivers. And, the sector's still at a 20% discount to the S&P, despite the fact we think we're in a higher growth, higher inflation, higher rate world, perhaps with deregulation and M&A still ahead of us. So definitely we're seeing that broadening theme through earnings. We still like technology. I still think AI adoption is going to be a big driver of good stuff in the economy and in the markets. But I think being too concentrated by sector or by geography is not the right strategy.
So interesting, Grace. As always, thank you so much for joining us. Grace Peters, Global Head of Investment Strategy at JPMorgan Private Bank. Coming up, more from our interview with the Unilever Chief Executive, Hein Schumacher, after the company delivered a sales beat but warns of a slow start to 2025. That's next, and this is Bloomberg.
As well as in Q1, we are seeing markets slowing at this point. And look, at the end of the day, we want to grow ahead of the market, with the growth action plan that I talked about. And I think we have a very clear strategy about that. But of course, market sentiment is important, and we see it slowing a bit. So we expect growth in 2025 to be more backweighted. We have invested a lot over the last couple of years in markets to be a bit more self-sufficient. I think we did that generally after COVID. So in the US, we've invested quite a bit. Around 85% of what we sell in the US is produced in the US. And it's about the same when it comes to ingredients. Now, there are flows between Mexico and the US. They are not material to the group, and as well as between the US and Canada and vice versa. So we're still navigating through that. We are localizing production where we can to adapt, and then the remaining impact is not material to the group.
Well, the Unilever chief executive there on a slow start to 2025. Now, Honda and Nissan have scrapped tie-up talks, formally ending negotiations. The deal would have created one of the world's biggest automakers. Meanwhile, Nissan has cut its operating income guidance for the full year as it missed estimates. Coming up, we talk UK after GDP surprises to the upside. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Presidents Trump and Putin agreed to talk to end the war in Ukraine. The U.S. Defense Secretary insists the discussions are not a betrayal of Kyiv. European stocks and the euro rise as U.S.-Russia talks spark optimism. The pound strengthens as the U.K. escapes the threat of recession. Plus, Barclays falls as its results underwhelm, despite traders turning in their best fourth-quarter performance in at least a decade. So back to our top story, and European leaders are insisting they should not be sidelined after U.S. President Donald Trump said he'd agreed to negotiate an end to the war in Ukraine with Russia's Vladimir Putin. They have also emphasized the need for Europe to invest more in its own defense. Meanwhile, U.S. Defense Secretary Pete Hegseth reiterated calls for NATO to increase spending to 5% of GDP.
Even 2% of GDP is not enough. 3 and 4, and ultimately, as President Trump has said, 5% of defense spending is critical. A realization that there is a Russian war machine that has sought to take more and more land in Ukraine.
Now, for more, let's bring in Bloomberg Opinions columnist Mark Champion. Mark, first of all, thank you so much for all of course, your columns and for the invaluable help you give us to try and figure out the situation. The situation, frankly, is very fluid. We don't really know what Donald Trump and Vladimir Putin discussed. How do you see this going?
Well, I think you're absolutely right. We don't know the details of what's being discussed. However, what we have seen in the last kind of 72 hours is a lot of public positioning. And what that positioning says is, Trump is not interested in doing this together with Europe. His national security advisor had said he was going to go to Munich later this week and consult with European allies before talks began. Trump clearly is not interested in that. He has begun the talks without consulting with Europe. So that is just a fact. The Europeans are obviously shocked and will try to get involved. But Trump's intent is pretty clear. Secondly, Hegseth, the U.S. Defense Secretary, had to kind of defend what was being done, saying it's not a betrayal of Ukraine. The reason he had to do that was that he had gone to NATO and said, a number of things that everyone in the room knew would probably have to be made as concessions as the result of any deal. But he gave them away before a deal, any negotiation has really begun. And so that was the shocking part. So, the fact that, he said Ukraine will not become a member of NATO, that U.S. troops will not be involved in any peace force to create a settlement and a ceasefire, and that Ukraine will not be getting its territory back to the borders that it had before Russia first invaded in 2014. So all of these, none of that is shocking in itself. Everybody understands that these are truths, but the reason they haven't been sort of offered aloud is because they were supposed to be negotiated in exchange for concessions from Russia, and as far as we can see, that hasn't happened.
So, Mark, what should Europe do now?
I think Europe is in an extremely difficult position. They're basically being told by Hegseth that U.S. commitment in terms of military aid, finance, etc., to Ukraine is going to reduce. Again, the Europeans understood that was going to happen over time. The question was when. The hope was that it wouldn't happen before a deal was made, because then you, again, are signaling to President Putin in Moscow that the U.S. money is disappearing quickly, and there's therefore no reason for Putin to sort of make concessions. He can hold out, wait for the money to stop, wait for the arms to stop, and his forces will continue to make advances on the ground. So, it all is looking very difficult for the Europeans, who understand that they don't actually have the resources to fill the void. It isn't that, as Trump has claimed on a number of occasions, the U.S. is providing the lion's share of aid. The actual aid delivered is actually about 60-40 European to American. The point is that 40% is incredibly important in the substance of what it is. And it will be very difficult for the Europeans to do this on their own. That's understood by Zelensky in particular, who said, without American troops, we can't do this.
Mark, thank you so much. Our Bloomberg opinion columnist there, Mark Champion. Now, let's also get some corporate news. KKR, we understand, is set to consider a Nissan investment, and this is after the Honda talks have ended. So we understand through sources familiar with the story that talks between KKR and Nissan are ongoing, but they may not result in a deal after Nissan's talks to combine with Honda failed. Now, other companies, including Hon Hai Precision Industry, Foxconn, are also showing interest in Nissan, with Foxconn's chairman also open to buying Renault's 36% shareholding in Nissan. So this is a very quickly developing story, and we'll keep a very close eye on it. Let's also switch focus on the UK economy. Registered unexpected growth at the end of 2024, with GDP expanding 0.1% in the fourth quarter. Now, we're now joined by Sonali Punhani, UK economist at Bank of America. Sonali, thank you so much for joining us.
Thank you.
There's a lot going on, and of course, the UK is not immune to all of these trade wars and trade concerns. First of all, how many cuts are you expecting this year? I know Catherine Mann kind of upended forecasts very quickly because she was much more dovish than almost anyone else, and especially from her initial position.
Yes, sure. I mean, we continue to expect 3 more cuts like we did previously, so we didn't really change our call after looking at Catherine Mann's vote. I mean, look, I think the committee has different opinions. There's divisions and different views across the committee, and I think what I tend to focus is on the guidance that was given by the majority of the committee, which still said that we need to have a gradual path of rate cuts, especially in an environment, as you said, where there's a lot of uncertainty both on the domestic as well as the international front. I think inflation persistence risks are still quite dominant in the UK, and that's going to keep the bank quite cautious. And I think there are obviously growth concerns, but firstly, today's data was encouraging in that sense that the growth weakness was not as bad as people were expecting. But we also also expect that growth should recover going into the year as some of the fiscal easing kicks in more.
I mean, that's the problem with growth in this country, is that it's kind of flatlining.
Yes.
Right? It's not bad, it's not good, it's kind of okay-ish.
Yeah. But I think you have to see, in terms of the Bank of England's perspective, is that how much of the growth weakness actually leads to lower inflation. And what's happening is that even if growth is weaker than what people would like, inflation is still quite strong and is still quite robust. So for the bank, they have to manage this trade-off. And as a result, I think a cautious strategy at this point is something that they would, that's sort of in our base case.
Sonali, I mean, is there a worry about consumption? And again, it's just very difficult to kickstart that. And it's unclear whether this is because of future worries, future unemployments. We've had a number of surveys. But is there anything that either fiscally or the government or the Bank of England can do?
Yeah. No, look, I think if you look at today's numbers, right, obviously it was stronger than expected. But you look at the details, household consumption was flat after, growing quite robustly in Q3. So it does seem like the private sector is weighing down, and a lot of the heavy lifting of growth has been done by the public sector. I think there are concerns. Consumer confidence is weak. We have our own survey of consumer confidence that's also showing quite a lot of weakness in line with what the other surveys are showing. And I think for the confidence, what we need is that there is, obviously rate cuts is something that can help, and maybe less worries about job losses is something that can help as well. So as we go through the year, maybe if some of the fears on unemployment do not materialize, that's something that can cause people to start spending more. If you look at real income growth, that's actually quite strong. So the fundamentals are there for the growth. It's just that caution is basically allowing people to not spend and save those real income gains. So savings rates have gone up because consumers are worried about the future. I think there needs to be, obviously there's been some change in the narrative. If the job losses don't materialize, I think those are things that can kickstart consumption along with rate cuts, because that's another boost to consumption as rate cuts come along.
But also a lot of these forecasts actually put the Chancellor in a very tricky position.
Yeah, I think, look, there has been some moves in the gilt yields that really do, reduce the headroom that the Chancellor has. Of course, there's been a relief from the highs that we saw in January, but still gilt yields are higher than where they were when the OBR did their October budget. Growth could be downgraded. We don't know. There were some leaks that maybe it does, maybe it doesn't. Today's number might help that. Yeah. They might not need to downgrade it as much. But, look, it is a difficult position. I think the headroom is a big question mark, and it does raise risk that in the spring the Chancellor would have to announce some fiscal consolidation measures, maybe in the form of some spending cuts in order to restore the headroom and get back to a decent headroom.
And Sonali, all of your forecasts, of course, have this underlying kind of concerns, on geopolitics. Yes. If the UK can avoid tariffs, which for the moment it seems it could, but again, it depends on which way you see it, the current account deficit, will it be in a stronger position than other G7 countries, apart from the US?
Yeah. I think, that is an advantage that the UK has, that a lot of its trade with the US is in services. We don't have such a big deficit relative to the Eurozone. So in that sense, there are more chances that the UK avoids tariffs. And therefore, the sort of drag from tariffs is probably going to be lower on the UK than others. Having said that, UK is still an open economy. And if there are global weakness in different big European economies or in China as a result of it, it's something that would affect the UK. But I would say, out of the, from a relative position, UK is better placed to absorb the risk of tariffs.
Sonali, thank you so much for joining us today. That was Sonali Punhani, their UK economist at Bank of America. Now, coming up, Barclays leaves its earnings guidance for next year unchanged, sending shares tumbling. We'll talk banks next, and this is Bloomberg.
I expect that you will see some rebalancing. But, I should say that we want the rebalancing in the context of strongly regulated markets. We think all the major banks, us included, are advocates of a well-regulated financial system. It's what makes London great. And so there should be some rebalancing, but in the context of a well-regulated financial system.
Well, that was Barclays Chief Executive CS Venkakrishnan speaking exclusively to Bloomberg after the company reported investment bank revenue and pre-tax profit beats. But shares lower today in Barclays after it left earnings guidance for next year unchanged. Now, we've had a lot of European bank earnings this week. Commerzbank vowed to increase profitability and cut thousands of jobs in Germany as it seeks to avoid a takeover by rival Unicredit.
The job cuts are very much related to two things. One is offshoring, and the other thing is digitization of our processes. And that concerns specifically corporate center functions, operations, and staff functions, and it's primarily in Germany. On the other side, and that's the investment part, which we also have, we will further recruit also in Germany a lot of talents. We will build up also still salespeople. We have a growth of staff in mBank, and we will increase the staff in our DTCs, our digital technology centers in Sofia, in Prague, and in Łódź, and in KL. We will also invest further in new skills.
Well, yesterday we also spoke to the Unicredit chief executive, Andrea Orcel, about the Italian bank's earnings and its potential takeover of Commerzbank.
We're optimistic that when the emotions are off the table and we can focus on what this really is and what it brings, we're going to be successful in having support.
Now let's get more analysis on the recent European bank earnings with Viki Farmaki, a senior analyst at State Street Global Advisors. Viki, thank you so much for joining us. Now, you can't talk specific banks, but actually in general, when you look at European earnings and EPS, what's the general crop like?
Well, so far the earnings results season has been very positive. In fact, we've seen a continuation of the trends of the past couple of quarters where European banks have outperformed the overall market. We've seen good capital, good profitability, good asset quality. The one trend that's also continued from Q3, though, is we're seeing some softness in net interest income. And that's especially for the banks that have exposure to the short-term interest rates, and many of them are in the periphery. But at the same time, those banks have good deposit franchises. They're able to cut deposit rates. They're passing on the ECB rate cut. They're put on hedges. And in fact, the net interest income has been more resilient than we have expected. That's why we've seen a bit of a relief rally in the European banks here to date. They've had a very strong performance, once again, outperforming the market. We're also seeing fee income growth be very strong, especially in the investment banking side. We see that reported today. Similar to what we saw from the U.S. peers, very strong IB performance, very strong fee income growth.
But Viki, so just very broadly, if you look at European banks, and there's a consolidation phase which may come or not come, Italian banks are trying to, definitely consolidate. Then you have the Swiss banks and the UK banks. Is there a first mover's advantage?
I think it's domestic. Each country has its own structure that they have to sort of work through and make it profitable. I think the Swiss, the UK, and the Eurozone are very different in terms of how the banks are structured. And I think in the Eurozone, we did need some consolidation. We're seeing that taking place domestically. We saw announcements in Spain. Now we're seeing in Italy a consolidation phase taking place. Now, that can be beneficial. It has to be executed properly and aligned with the interests of the shareholders. But I think we definitely need a consolidation in the Eurozone. We're seeing that.
If you look at earnings per share in European banks, are they automatically going to be lower than U.S. banks because of U.S. exceptionalism, but also deregulation?
There is some headwinds, of course, for the Eurozone banks. And I think as we go through this year, there's going to be divergence in performance. Their banks are, as we said, more exposed to short-term curves. Others that have longer duration, those that have good fee income franchise. I think those are going to be the ones that are in the best place. They have diversified income streams, and they're investing on the fee franchise. And that's why we've seen a lot of bolt-on M&A take place within the fee income platforms, and I assume we'll continue to see more of those because the net interest income will normalize as rates come down. So I think they need to work on the fee income growth. Loan growth could come through, but it's very subdued. Right now we're having green shoots in Europe around 1%, US 2 to 3, UK to do 3%. They're still lagging. Hopefully, as we get through the year, depending what happens in the macro, of course, we can see that loan growth coming through. But right now in Europe, it's very subdued. So the focus is on fee income growth and building those franchises. And that's what we're hearing from management teams. They're really investing in digital capabilities. We've heard that this morning. And they're investing on fee income growth. And M&A is playing a part on that as well.
Is it the UK and European banks with a bigger investment bank that will actually benefit more than others?
I think investment banking is one of those fee-generating activities that will be beneficial. There's other areas such as insurance, asset management, that's also and wealth and private credit that's providing areas of fee generation. I think it's a combination of those, and I think you want to have good market share and good quality franchises within those businesses, and all of them have growth potential.
Viki, overall, how tricky will it be for European banks, European and UK banks in the 12 months ahead?
Well, European banks are the most macro-dependent of all the sectors. So it's going to be very tricky this year because, as we know, macro uncertainty is high at the moment. And that will create volatility within the banking sector. But at the end of the day, they have good fundamentals. They have de-risked the portfolios. They're nothing like they were before the great financial crisis. They have high capital ratios, double the size. And there's certainly a good quality capital. And they're paying back a lot of that. Buybacks, dividend yields high. So the fundamentals and what the banks can control are very solid. Now, the macro, that's another story, and banks are linked to the macro. So that has to work. And, of course, we have to see how those policies play out.
Viki, thank you so much for joining us today. Viki Farmaki, they're a senior analyst at State Street Global Advisors, specializing in financials. Coming up, Alibaba shares surge on reports of a partnership with Apple. We'll have all of the details next. And this is Bloomberg.
The whole story about DeepSeek is also putting a little of self-confidence into people's minds. So therefore, demand will come back. Government is taking actions. It's not a kickstart, I would not say that, but we see that this economy is picking up momentum, in particular in the space where we are, which is the investment space.
That was the Siemens chief executive, Roland Busch, on DeepSeek and China demand after the company reported rising revenue on robust demand for electrification products. Now, Alibaba's chairman has confirmed that the company's partnership with Apple at the World's Government Summit in Dubai. Speculation around the deal has seen Alibaba's shares soar to their highest since 2022, expanding its market value by nearly $87 billion. Now, joining us now is a Daybreak anchor, Tom McKenzie, who's also expert in all things tech. So, Tom, great to speak to you as always. I mean, this is a new China AI darling. So what exactly is Alibaba now compared to what it was 4 years ago and what it was like 2 months ago?
I mean, Alibaba was a sprawling business. At the heart of it was e-commerce. It had its cloud business, a supply chains business, even a supermarket as well called Hema. They are now trying to, as a result of all the knocks that Alibaba has taken since the crackdown on technology companies in China, since, of course, the impacts of COVID and the consumer being hit in China, they've refocused. Joe Tsai, the chairman, one of the co-founders of Alibaba, refocused on the core business, e-commerce, but cloud as well. Spending on cloud, spending on AI, investing in AI startups. They've lent in to the AI revolution. And now it seems to be paying off. As you say, Apple partnering, the chairman announcing today, partnering with Alibaba. We know Apple would have been looking undoubtedly the likes of Baidu and Tencent. They decided to go with Alibaba. Good news for Apple because they've seen their sales slow in the Chinese market, about 11% in the holiday quarter, partly because they can't offer those AI solutions and services that they can here in Europe or in the US because they didn't have an accredited partner. They need to have an accredited partner in the Chinese market. Now they have one with Alibaba. So Apple possibly should get a lift on the back of this now that they are able to provide those AI services for the first time in the second largest market for Apple.
Yeah, and as you say, this is huge for Alibaba, actually winning that, and I guess it's only upwards now.
We have the results next week on Thursday from Alibaba, so they will be scrutinized to see to what extent the innovations and the progress they've made, to your point, on developing models, AI models, that now really do compete with the kind of models produced by the likes of Meta, the Llama models. Alibaba's models compete at the top line. Are they producing return on investment for Alibaba? That will be scrutinized in the results next Thursday. The partnership with Apple, clearly a positive. The stock up, as you say, more than 40% year to date, added more than $80 billion in value. We'll see if it continues for Alibaba, and there will be a lot of scrutiny on those earnings. But so far, they've made progress on innovation around AI, and they will be hoping, of course, that continues to pay dividends across their business units. And we'll see if that comes through in the results next week.
Tom, thank you so much. Tom McKenzie there with the very latest, of course, on Alibaba and Apple. Up next, a Bloomberg Brief. Danny Berger and Maz Karani in New York. There's a lot going on as we focus on geopolitics, markets, and finance. This is Bloomberg.